You're listening to the Franchise Freedom Podcast with Giuseppe Grammatico.
Hey everyone, welcome to the Franchise Freedom Podcast. I'm your host, Giuseppe Grammatico, your franchise guide. And today we have our first ever repeat guest, David C. Barnett. David, welcome to the show.
Hey Giuseppe, how you doing? I'm happy that you invited me back. I guess I didn't say anything too awkward or embarrassing last time.
Yes, no, actually, yeah, we got some really good feedback. I'll be honest, to everyone listening, and I learned a ton from our conversation. And for everyone listening, and David is now my go-to guy for, how do I sell my business? What's the exit strategy? Instead of trying to answer those difficult questions, I refer them right over to David. And today, changing the format a little bit, want to talk about exit strategies. And I am going to send this episode out to anyone that has any questions about exit strategies, because that is a very popular topic and it could get complicated. There's a lot of, it depends and what industry you're in. So I want to take a really quick deep dive. So before we get into that, so the format, as I mentioned, is going to be a little bit different. David, can you fill us in just a little bit on your background, and then we'll start diving into exit strategies?
Yeah, sure. So, out of university, I got into sales and eventually left that and started my own business. Didn't like that business after a little while, and I sold it. And that was the first introduction to the world of buying and selling businesses. I then ended up being a finance broker for small, medium-sized businesses, helping people get loans and things for equipment and buildings and everything to grow their businesses. And then the financial crisis came, and I ended up pivoting into business brokerage, ran a business brokerage for 3 years. That's a terrible business because your cash flow is up and down. You only really get paid when you make a sale. And after about 3.5 years of that, I realized I needed something more regular, became a banker for a while. And just like, what's that famous scene from, is it Scarface? They kept pulling me in or
yeah.
Gangster movies. And so my phone just kept ringing from people looking for help to buy and sell businesses. And I ended up re-entering the world of buying and selling businesses as a consultant and coach, where I help people through the process. I'm not a broker, but I just work with my buyers and sellers, helping them get through the deal, helping them navigate things. Mm-hmm. And along the way, I've written some books. I've got a YouTube channel. And so basically, I've been working with small, medium-sized businesses for over 20 years now, and particularly in the world of buying and selling them for over a dozen years.
Wow. So you've done a little bit of everything. You've and that's what I like about you. You have the experience. Seems to be working really well. I've sold my business. I wish I spoke with you several years ago. Unfortunately, we met afterwards, but definitely a wealth of content, lot of personal experiences that you can share. So what is the number one question I get so often? And it's, I get into a business. So you look at a couple things, right? It's what am I going to make? What's the seller's or the owner, I should say, what is the owner making from everything, right? There's a tax benefit, there's the revenue, there's the expenses and things like that. But also the real wealth, in my opinion, is when you go out and sell that business, and there's various multiples you can use and things like that. So I always tell the really quick story, and we were talking right before the show. When I bought my first franchise, I was really nervous. I was my mid-20s. I'm signing the check, which, by the way, I had to redo because I where I put the dollar amount, I put it in the wrong section. It was a big deal. It was the biggest check I ever wrote. Even bigger than when we bought the down payment on our home. And so I was really nervous. I did the check again. So the franchisor shakes my hand and he goes, "Do you have any questions?" And he's probably expecting me to ask, when can I start? When's training? And I go, how do I sell this thing? And I said it jokingly, but that was really, my not my concern, but something that really interests me, because eventually I'm going to sell this, and I want to factor that into, selling it, maybe, an additional investment and that kind of thing. So, and that's a question I get from candidates all the time. We're looking at a franchise business. I'm looking to make X amount, and they forget about that sale. So if you can walk us through maybe just, and we're going to spend most of the show and just on exit strategies as far as how to approach it. Does it make a difference if it's a business worth, or I should say a business netting, an owner maybe $100,000 on $1 million versus, they're doing a lot more in volume? Does that affect the multiples? If you could just talk a little bit more about that.
Yeah. So, I think, first of all, just to build upon the story that you just shared, I think that people who invest in a franchise are actually in a better position to get mentally through this exercise than people who might start a business.
Okay.
A lot of people who start a business, they need an income, right? And we've heard that expression, necessity is the mother of invention. So they get into something, they start earning money, they're concerned about what they're doing today. And once they get that lifestyle going where they're making enough money, then they kind of breathe a little sigh of relief. And it's only later, when they have more time to think, that they start to think about this exit. When someone's buying a franchise, whether an existing location or investing in a brand new location, you are writing a big check, as you described, Giuseppe. And so you're making an investment in some kind of asset, like buying a house, for example.
Right.
And so I think it's easier to get your head around the idea that this is an investment I'm making, and what does it look like when the day comes when I want to sell it again? Stocks on the stock market's easy. You call the broker to buy one, you call the same broker to sell it, or you do it online or what have you. With franchises, it's a little more difficult because while you're investing in a business that you're going to own and run, you're also in a relationship with that franchisor who creates all of these additional rules that you have to live within that other independent businesses don't have. And so a lot of the times when you're making that decision to invest in a franchise, you want to talk to the franchisor about how do you sell it, because I've found in my experience, the franchisors fall into two different categories. The franchisors that have an exit program already built and established, these tend to be the older franchise names that have had a lot of units that began to be faced with the issue of people wanting to exit and how are they going to manage these new buyers coming in. They have to ask themselves, are we going to have a different process for resales versus new sales, right? There's all kinds of things that go on over at the franchisor's office about how they're managing the growth of the network and all this kind of stuff. And so some of the newer franchise brands, they may not have an established process set up. And so you want to ask about that. You want to make sure that you understand. And as far as running the business, here are some of the things I've seen over the course of time. Sometimes franchisors will provide different kinds of systems or operating tools to help people run their business. And, franchisors are going to come, they're going to do inspections, they're going to make sure that you're operating properly. They don't always necessarily make sure that you're following every sort of aspect of their system totally and completely. So they could provide you with some kind of management tool to help you run the financial side of the business, for example. And if you don't quite follow that to the T, maybe they don't notice. They're more concerned about how you deal with customers or the quality of the work that's being done, depending on what the system is. But if somebody comes into that franchise system looking to acquire an existing location and they've gotten information from the franchisor and they maybe have already seen the operations manual and they've seen all this stuff, when they come and meet you as a potential acquisition target and you're not following all the different things that they've been shown already, it can actually be a concern to that buyer because they're looking for all of the value that comes from operating within the systems of the franchisor, right? And, the other thing that has surprised me over the course of time is the fact that some franchises out there who are big, well-known names. I've got a buddy of mine who's a franchisee, and I'm not going to use the name of his franchisee, but when people say franchise, they often think of this name. This franchisor provides systems and processes for absolutely everything except bookkeeping. And so you've got different franchisees across the country. Some are on Sage, some are on QuickBooks. Some of them own multiple locations or using a fancier accounting package that's more suitable to them. And when they get together at their annual meetings, they're trying to compare notes with each other, but there's a lack of standardized reporting in their businesses. Now, they all make the product exactly the same. There, no question about that. And they all are participating in the same advertising. But there are certain things that some of the franchisees themselves even wish that they were having some sort of system imposed upon them. So it's kind of interesting, the different things I've seen over the course of time.
Yeah, that is interesting. And to that point, it is typically in the franchisor's best interest because typically, I would say 9 out of 10, if not more times, the franchisor is getting a percentage of gross revenue. Some charge tier pricing, a flat amount every month, depending on volume. So that is interesting, and these are important questions to ask when you're doing your due diligence. I will say too, with every franchise does things differently, and these are, as you mentioned, to your point, absolutely. That's part of the due diligence. What is your process? In many cases, the franchisor, I am a franchise advisor, coach, and consultant. They all mean pretty much the same. Everyone has different terms for what we do, but they may use a company like basically the service that we offer to help find buyers for that business, and they'll tell you, okay, the fee is going to be X amount to sell, and then there's a transfer fee, because the franchisor, at the same time wants to meet that buyer. They want to make sure that they're a good fit. And it's usually not a huge issue, but they just don't want you just selling to anyone. They want to make sure that, to your point, that they're following that system. So when they are doing their due diligence, absolutely, they're going to speak directly to the franchisor and to the franchisee. And if there's a disconnect there, that needs to be rectified really quick, because if you're buying a franchise, the value's in the system. So if you're not following it, you're not getting the value proposition, and maybe that's why you didn't succeed, maybe particularly with that business. So just my 2 cents on that.
Well, and you asked a question when we started off here about multiples, about how a business is priced. Mm-hmm. And so here's another question that new franchise owners may want to have answered for them. And it may not be the franchisor who's going to answer this question for you. You might want to talk to somebody else, like a business broker or someone like myself. Every different industry is going to have a different multiple. So let me explain this briefly. Businesses that are already operating are valued based on the cash flow they produce and the amount of risk that buyers perceive in that industry. So a food service business is going to have a lower multiple than some kind of industrial service, business to business type of business, because that industrial services business is going to be seen as less risky than a retail food restaurant. Okay. And so different industries have different multiples. And as the business size changes, the multiples change as well. So smaller businesses have lower multiples than bigger businesses in the same industry, because the bigger it gets, they're seen as less risky. So your corner sandwich, submarine sandwich franchise that does a few $100,000 in sales, that earns 6 figures for the owner, is going to have a certain multiple. But in the same industry, food service, you can have a big sit-down franchise that does $2 million in sales, that earns its owners, $250,000 a year. It's not the same multiplier that's going to be applied to that bigger business. They're actually going to get a higher factor when they multiply that $250,000, because that bigger business is going to be less susceptible to the negative impacts of losing a certain customer, or you can just imagine, if you decide you're never going to go back to Dunkin' Donuts ever again, they won't notice. Right. But if you're going every week to the little corner sandwich shop on the end of the block, and you're buying lunch there every week and you don't notice, well, on $100,000 or $200,000 or $300,000 of revenue, your $500 over the course of the year will be noticed, right? It adds up to something. And so this is why smaller businesses trade for lower multiples. They're seen as being more risky. Now,
I didn't know that. Not to interject, but yeah, that's interesting. I've never had it explained to me that way. So very, very interesting. Learning every day.
Well, these multiples are not made up by people. Right. They are discovered through the transactions, just like residential home prices are set by the fact that, someone 2 blocks over bought a house similar to yours for a certain price. That affects the price of your business. When we're looking at this, what we're doing is we're looking at past transactions for businesses in the same industry for the same revenue category. Right. So the same size of business. And then we'll see what other people paid. And that's the reflection of the risk that those buyers saw, which likely is going to hold out for the next person in the next transaction. So here's the question, though, is now that I've gotten all that multiplier stuff out of the way, is if I'm going to buy a brand new franchise, the price I'm going to be paying is based on the franchise fees, training fees, and the building out of the new business, acquiring equipment, whatever it happens to be. So I have to make this investment to make myself ready to serve customer number one. Once the business is operating, no one really is going to care what I paid.
Right.
Because now that it's an operating business, everyone's going to say, what's the cash flow and what's the multiplier? Mm-hmm. And so the question that I think a lot of franchise investors should be asking is, what level of profitability will my unit have to have in order for me to be able to sell it for what I paid? And so this is an important kind of consideration, because you could very well invest $1 million in a brand new franchise business, mm-hmm. get it up and running, start making yourself some money, but you're not making enough for anyone to pay what you paid. And so the resale value of that unit is going to be lower. And, you know, sometimes people will get into trouble where they'll open up a new location and they won't make as much money as they want. And they'll say, oh, this isn't for me. I'm not operating or executing properly, or what have you. I'm going to sell and get out. And then they're very rudely shocked by this kind of reality, because that unit now is not going to be bought based on the projections and opportunities and everything that franchisors might be presenting to people. It's going to be bought based on what you've actually done. And so sometimes if things aren't going well, we have to figure out, how can we fix this business before you can exit? Because not only do we have to get the numbers up, we then have to get the numbers up and show that the numbers are sustainable.
Right. Typically,
that means 2 years of results. And so operating the business, having good profitability, franchises, you know, you said how franchisors are typically taking a royalty based on sales. Mm-hmm. What that means is that a lot of franchise systems will have a good degree of automation and systematization in the POS part.
Yes.
Maybe not in the back end bookkeeping, but what you want to do as a franchise owner is you want to try to run the business cleanly. Don't put a bunch of personal expenses in there to try to save on taxes. It's just going to create headaches for you when you try to sell. You may be able to convince a buyer that, you know, your spouse's fuel expenses and your teenage daughter's cell phone bill aren't really business expenses. The problem then is the buyer convincing his banker that there's a departure from the tax returns.
Good point.
So that they can get a loan to buy your business. And that's really, when you sell a business, it's not just the buyer you have to convince, it's all of the people surrounding that buyer, their attorney, their CPA, their banker, and any other advisor that they bring in on the deal.
Yeah, no, that's a very good point. And I hear that quite often. You know, what do you say? So came across a situation where this one particular company was a small mom and pop. You know, they were purchased by an investor who was purchasing multiple concepts. We'll just say, just to make up an example, in the mosquito spraying space, I want to keep everything confidential. So one company acquired 5 or 6 companies, put them all under one umbrella. Comment I heard, which was, this is all new to me, and I think we had mentioned this before the show, was, okay, this one company paid 2.5 times earnings, and his goal was to acquire 6 to 10 of these smaller companies, put them together, and sell at a higher multiple, because he was getting into the $4 to $5 million range. Mm-hmm. You know, obviously, he's going to be making more total. Maybe the percent is still whatever it is, 20%, 30%, whatever the numbers were. But is that the case? Once you hit certain revenue numbers, your multiples start to go up as well?
It's a great question. And this is something that catches and confuses business owners all the time. So remember earlier how I said 2 businesses in the same industry, one is bigger, earns more, will sell for a higher multiple?
Right.
So don't forget, it's the multiple is applied to the cash flow. So as the business gets bigger, mm-hmm. And in this case, we call it a roll-up. So he was buying 5 or 6 businesses to assemble them together to make a larger entity. So he's de-risking, because now he's got all of this huge customer base across 5 or 6 former businesses are all pooled together into one. And so someone's going to see that cash flow as being more stable. Mm-hmm. A lot of entrepreneurs get caught in the trap of thinking that it's all about the revenue. Doubling the revenue is going to double the value of the business. No, you have to increase the cash flow And then when you go to sell it, that multiple of cash flow might be a higher number. But the trap that I've seen so many people fall into is that they want to grow the revenue and they start adding unprofitable business. They start doing a lot of sales promotions, adding a lot of customers at a low price, because they think that if they can get their total revenue up to a certain level, this is then going to be the thing that really drives them. I looked at a business 2 days ago with someone in New Jersey, 3.2 million in revenue and barely any profit.
Wow.
And the question is, what's it worth? And the answer then is, well, what does a buyer think they can do with it?
Right.
And are they going to need to use their resources to fix this business? How much are they really going to be willing to give to a seller? Right. Because you're basically selling a business with no cash flow to pay any debt service or anything. So what is it worth? And this is why operating it is such a key thing. And within franchise systems, that's what people are buying into. They're buying into a proven methodology for running a business that's supposed to be able to deliver a profit. And so you want to be focused on that bottom line, making sure that you get your right gross margins and that you execute so you have that profitability so that there's something to multiply.
Right.
Yeah.
Very well said. Yeah, that explain that answers, and the way you explained it, as I mentioned, I'm just going to be sending people over to this episode. And actually, before I even forget too, if you go to the website or Franchise Freedom, you can go to, on iTunes, Spotify, you name it, Google Podcasts. It's episode 22. I think it was believe we recorded back in May of last year. So it's been almost a year now. So you could take a look, and it goes through a little bit more. We cover some other topics, but this has been great. I'm definitely going to be going back to this episode. One other question, and then I know there was some other talking points, because the whole show today is dedicated to exit strategy. So I recently sold my business about a year ago. And one thing I did not know, the individual I was dealing with different buyers. I listed it. I was doing a lot of it myself. Was the valuation was all over the map. The multiples, what was true profit, because I had two types of buyers, which, owning my first business 100% and selling it, to find out, okay, you have one type of buyer that was just going to step into my shoes. I was a semi absentee operator. I worked the business, 10, 15 hours a week. I had a general, not even actually, I was working less than that, but I had a general manager in place. And then you had, so they wanted to step into, I take that back. They wanted to step into the general manager's shoes and take over that role, that role. And others came in looking at it as an investment, and they were offering me a much higher multiple, saying they just want to walk in, and they were offering me 5, 6, 7 multiple, but on the net profit
of a different number,
paying, right, of a different number, of a lower number. So it was like, wait a second, we're all over the map. So I'm getting this higher multiple because the business was on autopilot, but they were looking at the profitability after paying my general manager. So what do you do in that case? I mean, when you go to list a business, what's your intention to sell it when you have two different types of buyers?
So the idea, and when you work with a qualified business broker, and I use the Q word in a very big way, and I'm going to emphasize it, qualified business broker, because a lot of people in the space and vast degrees of difference in expertise and experience. Okay. Mm-hmm. So you find a qualified business broker who you have confidence in, who's got references that check out, and you know that they're going to be able to do things. They're part of different associations, and you ask to see samples of their work. Mm-hmm. And they're going to help you prepare the business for sale. And when you prepare the business for sale, we create something called the package. Sometimes it's called a confidential business profile. Sometimes it's a confidential information memorandum. There's different terms for it, but it's a bundle of stuff that a buyer is able to look at. And so a properly prepared package is going to have two different kinds of buyers in mind. It's going to have what we call the financial buyer, who is a person who wants to replace their income. So this would be the example, Giuseppe, of the buyer who wanted to take over the general manager's job. Right. They're going to put 40, 50 hours a week into running this business. They're going to be the day-to-day manager and the owner. That person is going to be looking at this seller's discretionary earnings. They're going to say, if I buy this business, how much money do I get? Even though they're working full-time in order to get that money. So somebody who's looking at that, they're looking at multiples of sellers' discretionary earnings, sometimes called SDE, sometimes called SDO. There's, again, different terms for this. Those multiple numbers tend to be lower. So they're multiplying a number that includes their own labor, and so the number they multiply it out with is lower. The other kind of buyer is called a strategic buyer, and they are looking at this as more of a passive investment. They need someone else to run the business for them. They need a manager. So instead of that seller's discretionary earnings level of income, they're looking typically at what we might call normalized EBITDA, which is earnings before interest, taxes, depreciation, and amortization. It's not a true figure of cash flow. But the reason why people like to use that number is because it makes it so you can compare one business against the other more readily. Okay. Because every business really has to pay interest and taxes, and they have to pay to replace equipment. So it's not really the true cash flow to the owner. Okay. But they'll look at that EBITDA number because a manager's been paid, and they'll multiply that number, and they'll multiply it by a different kind of factor. This is where business owners really get trapped. Here's what I mean. Is there'll be some place like a golf course or a yacht club or some place where they're talking with other business owners who will then start to talk about how Joe over there sold his business and got 7.5 times for his business.
Right. And
then you'll meet with a business broker who says that small service industries with little in the way of capital equipment sell for 1.7 to 2.2 times SDE. And you go, well, Joe got 7.5 times for his business. How come I'm getting 2.2? The difference is that Joe's business is a bigger business, and it was sold not for a multiple of SDE or EBITDA. It turns out Joe had a trucking business, and it was sold for a multiple of EBIT because the depreciation and amortization won't be added back in that scenario because the depreciation on capital equipment is such a big part of the trucking business.
Right.
And so this is why people get into trouble, because they end up hearing these different things out of context, and they start to apply some of the things they hear in the wrong set of numbers within their own company or their own books. And the fatal flaw that happens is people end up with an inflated expectation. They begin to think that their business is $1 million business when it might be a $350,000 business. And the scariest thing there is that if you go out into the market with that kind of overinflated expectation, you don't actually ever meet the person who's going to buy your business, because people that are buying an existing business, they spend some time, they educate themselves, they watch videos that I've got on YouTube and stuff like that. They have an idea what the business should be selling for. And if they see a price as double that, they go, that guy doesn't know what he's doing. They don't go over and talk to you. The people who do talk to you are other people who don't know what they're doing. You may even sign a deal. That guy will go to the bank. The banker will tell him why it doesn't work, and then the deal falls apart. And then a year later, you begrudgingly realize, oh my goodness, it's not $1 million business. It's not worth anywhere close to that amount. But now a year's gone by, and let's talk about why people sell businesses. The top reasons people sell businesses are because of burnout and fatigue, divorce, poor health, the need to relocate, or retirement.
Right.
And so if you run into one of these circumstances, you begin to start to be distracted. And this means that your entire focus and attention is no longer on the business. So if you spend a year with the distraction in place while you're trying to sell the business, what then happens is the performance starts to erode. And now you get another set of financial statements, and these statements show a decline in sales and profitability. And now you've got your trend has changed. And now people don't want to average your last 3 years of performance. They just want to look at the most recent year, because now you have a downtrend. And so when the decision comes that now I need to sell, you need to get everything put together quickly so that you're ready to handle buyers in an expedient fashion. You need to have a realistic understanding of what it's worth, because you need to sell it before your own lack of interest starts to have an impact on the results. That's key. Did you get into that kind of feeling when you were looking at selling your business, Giuseppe?
Yeah, I mean, the situation, I originally had it listed with a broker, and we had it priced way too high, and it was frustrating. And I mean, you had one expectation, to your point, lot of misinformation. I am the first to agree there. Was confused, talked to other brokers. You should get 3 times, you should get 1.5 times. It was all over the map to the point where it was a distraction, and it did affect my business 100%. I'm honest. I wish I could say it didn't, but it did. So it affected my business, affected my morale, until I spoke with a few people, decided to do it on my own, and got some, being in the business we're in, there's a lot of buyers always constantly contacting us. So we were able to find a buyer. So, but yes, it did hurt morale, did hurt business. I'm sure it hurt the valuation of the business.
Yeah. And what happened in your circumstance, you tried brokers, then you went and did it on your own. In the world of small business transactions, there's no hard numbers on this. Okay. Mm-hmm. Nobody really tracks the market. And here's why. Most small businesses are sold in what's called an asset sale. Mm-hmm. So somebody registers, for example, in New Jersey, someone would register a brand new LLC to be the buyer, and then they buy the assets of an existing business, and then that seller might wind up their LLC. Well, over at the government, they record it as a business startup and a business closure. They don't really record it as a sale of an operating business. And so this is why the numbers aren't very transparent for small businesses. So it's as many as 80% of businesses are sold without any kind of intermediary at all. And so, here's an example of how this can happen within a franchise network. If you own a franchise and you decide it's time for me to sell, chances are, if there's someone in your network who's trying to grow, they might be your buyer, right? Your neighboring territory owner or someone within a reasonable distance. The other example would be that if you have a franchise that's well established and all the territories are bought up, there could be some guy 3 miles from you who contacts a franchisor looking to buy a franchise who's told, no, I'm sorry, the state's sold out. Well, if the franchisor knows you're looking for an exit, they might direct that person to you. So there could be an opportunity for you to find a buyer through the franchisor simply because, this person made an inquiry on a new unit and they can't help the person if they don't want to move. Do you want to talk about some horror stories?
Well, before that, and I want to say, we could definitely talk about that. I will say, yes, I sometimes I get calls. We find a franchise that's a perfect match. They want, all of northern New Jersey, which happens to be three franchisees, 3 territories, 3 locations, whatever the case may be. And none of them are for sale. None of them are listed. The franchisor may just make that quick phone call and say, hey, we have a buyer that's looking to buy the whole region. Is anyone interested? And we've had interest started that way. Nothing listed. Maybe it wasn't even a thought. And all of a sudden there are potential 3 locations for sale. So horror stories. Sure. Let's keep it interesting.
All right. Well, in the interest of full disclosure, here are some of the situations that I've run into when I was a business broker, trying to help people sell their franchise businesses. So the first one is the bait and switch. So the franchisee hires a broker or does it on their own. They go out looking for a buyer and they find a buyer and they meet the buyer and the buyer likes the business. And then as part of the purchase process, of course, the buyer then has to be approved by the franchisor. Mm-hmm. And so this happened to me a couple of times in a franchise network that did not have a resale program specifically. What would happen is the seller of the franchisee would introduce the buyer to the franchise head office, and it would be handed to the people who are the same people who would sell new units. And they would say, we're going to take an application from this guy to see if he's qualified. And the salespeople trying to make quota for selling new territories would say, you sure you want that old unit? I could set you up in a brand new place downstate, and you'd have a brand fresh new. And so this franchisee lost a couple of buyers because the franchisor sold them into new units.
I'm surprised they didn't have him sign a non-disclosure or something. And you know what? I'm not even sure if that exists, but you would think that would apply in that case.
Well, and this is why you want to have an understanding of what the process is with the franchisor, because in this case, it was the person in charge of selling new territories that was handling this process. They probably had some kind of quota or goal they were trying to meet. And that leads me directly into the second one. So this is another case. Again, this was a franchise that I had for sale. There were 2 units, very successful operator. Okay. This guy was always in the top tier performer amongst the franchisees, and he was often held out as a superstar at meetings and regional meetings, all this kind of thing. In fact, he was very good, and when they would have somebody fail, sometimes in a franchise network, you in restaurants, for example, you could spend a lot of money building a whole new restaurant, and then if you make a go of it, what then happens? Well, if you're failing and you're on the way out, the franchisor would like to try and save the investment made in building that location. They're going to try to find someone that's going to keep those doors open, because the franchisors collect a royalty on sales. So they would offer failing locations in the region to this guy for free, basically. They would say, you're such a good operator. We have somebody who's closing, an hour and a half away from you. Would you like an opportunity to have that place? We'll make it happen because we know you can operate it. And he would say no, because he knew that boots on the ground were a key to his success. Mm-hmm. He needed to be there. So when he decided to sell, I sold that business 3 times. So wow. On 3 different occasions, we had a buyer who would come forth. They would negotiate with the seller. An agreement would be made. Mm-hmm. Then the potential buyer would make an application with the franchisor and be rejected. And so after that happened the second time, we got this idea, hey, you know what? Maybe they don't think that these guys are good potential operators, and they're relying on the cash flow that you provide as a good operator. They don't want to lose you.
Right.
And so he had to have some stern words with head office and say, you need to approve the next buyer I bring, or you're going to lose me anyway.
Right.
At the end of my lease, at the end of our agreement, I'm going to explore other options. And that no one knows for sure what was going on at head office, but that was the feeling everyone got, mm-hmm. is that they were trying to keep him in there because they wanted his success. They wanted the royalty checks to keep flowing from his unit.
Yeah, that's a shame. And you know what, with practices like that spreads quickly. So when you are, I will say, full disclosure, when you are looking at a franchise, the biggest part of anything you can do, we can look at the financials, we can speak with the franchisor directly. I think the meat of it, of the due diligence, is validation with the existing franchisees. And mm-hmm. it's something like that's going to spread really quickly, because that's going to affect everyone. So people are going to be in an uproar. Not all franchises are built the same, and that's key. I said I can coach you through the whole process, making sure you ask the right questions, but that is something you would come across relatively quickly, and that would be a major red flag, even for myself if I'm looking at a franchise. So it's unfortunate you're dealing with people, and that should not happen, but that's just bad practices from that particular franchise company.
I agree with you fully, and I think that your solution is totally apropos. It's word gets around in every way, and sure. in a lot of places, franchisees become friends with each other. Mm-hmm. And this has got to be part of your due diligence, is going out and meeting other unit holders and finding out, how they feel about mm-hmm. the way things are run and how they're being treated by the people from head office.
Yeah, absolutely. And a lot of these concepts meet once a year. They'll have their national conference. I call it, it's almost like a mastermind, because just because you're all in a painting franchise doesn't mean you come for that. Odds are you never painted maybe a day in your life. So maybe you're a former accountant, or you own the retail, a restaurant. So everyone is kind of figuring out best practices, what's working, how do we all work together so that maybe we throw our money together in a pool and do an event, and we split it up based off of territory. So some major advantages, but you need to take advantage of that. If you're not going to the meetings, you're not talking to the franchisees, you're missing the whole value of the franchise in and of itself. So, that's a benefit. So when you are doing your due diligence, if you're getting a lot of red flags, that's a conversation I like to have with anyone I work with, and with the franchise company, because I need to know where we stand. If there's that many issues, they need to get resolved, or we move on and maybe we have to look elsewhere. So, really, really good stuff. You answered a lot of my questions, because I deal with this every single day, and I am not the expert. So I guess a question for anyone listening in. So traditionally, what I came across was, need to sell a business. What do? You go to a broker. You're not feeling well, you go to the doctor. So you go to the broker. And I felt, and this is not a knock against brokers, but what I felt was, okay, we're going to try to get as much as you can. And their compensation was typically, the number I came across, 10%. At first it was, you can work with a couple brokers. Then it was, you can only work with one broker. It was 10%. Maybe if the numbers were higher, it dropped to 8 from my personal experiences. I'm not speaking on behalf of all brokers. You're saying, from our conversations and knowing you're saying that your model, you completely reversed it. So if someone is thinking of selling their business, they can hire someone like yourself, correct? And figure out the valuation, how to fix it, and then and you show them how to sell their business?
Yeah. So basically I've ripped off the business model of CPAs and attorneys. So what I do is I basically just have a menu of the steps and the services that go along with them. So when I'm working with a seller, I'll do the evaluation, then I'll create that package for the buyers. And then if they need help to run the advertisements to bring in the potential buyers, I'll do these things for them, and I'll charge them for each step that I take them through, much like an attorney is just going to charge you for having some contracts made or whatnot.
Right.
And then at the end of the whole process, when the business is sold, there's no commission or anything. So the reason why it works is, when I was a business broker, I had to handle a lot of files that never sold. So
right.
I wasn't getting paid on some of the files I had, and I had to make my living from the files that sold. Under my current business plan, what basically happens is everybody I work with ends up paying me for what I'm doing. And it means overall I can charge less. And, a lot of people like that process a little bit better.
Well, you're offering value, right? I mean, there's the service of, you're going to need a year before you can sell it. I'm going to coach you through how do you, maybe the revenue is fine, just your expenses is really low. How do we do that to show that uptrend? So I see it as complete value because you're offering so much coaching and advice and working directly with them.
It's interesting that you bring that up, because a lot of the times with business owners, what will happen is I'll do the first step, which is the evaluation, and they're disappointed with the number.
Right.
And then I'll be able to go through and say, this is why the number is where it is. And if you're trying to get to this other number, here are the changes that have to occur. And then they'll go work on their business and then come back after another set or another 2 sets of financial statements have come back. And then it's very easy once it's been done the first time to then rework the new numbers into it, show what the progress has delivered, and then they can make the decision of whether they're going to go to the market or not. Excuse me. So, but here's the thing, is that requires foresight.
Right.
And so as a business owner, it's imperative to keep in mind that this is an asset you have, like a stock you might have in your portfolio. There could come a time where I want to exit out of this. I need to have it in as good and shiny a condition as possible to make sure that when I want to sell it, it'll be sellable.
Right.
And unfortunately, a lot of people get caught in a lifestyle groove where they're working every day, they're earning enough money, they're doing those little things to reduce their tax obligations. It means on paper the business doesn't quite look as good, but hey, they're living, high on the hog and they're doing well and they're happy. Then they get sideswiped by one of those things that we never foresee. And one of the other things that I've seen talked about quite often is people will talk about how the exit from your business is going to be like this huge thing. When we're talking about most small businesses, Mark Zuckerberg, when he exits from Facebook, he's going to be, totally wealthy. There's no question. But for most small businesses, we're talking about relatively low multiples. The most common comment that people say to me when I do an evaluation on their business is they'll say, well, if I just stayed for a few years, I'd have the same money. And I go, yeah, that's true. It rarely makes sense to sell a good, profitable business. The profits you enjoy as the owner of that business, that is where you're going to build and create your wealth. You need to make sure your business is profitable every day so you can take money out of the business, invest in other things. Business is risky. We don't know what's going to happen to affect your market, government rules, global pandemic. Who knows, right?
Sure.
So make money every day. And then when you can't run the business anymore, we do the best we can to get as much as we can in the shortest order of time so that you can exit before your own changes in attitude and opinion start to affect the business.
Right. Yeah. And we had, without getting into details, I know we're coming up here close to 1:00. I had sent over a good friend of mine that you had spoke with. And sometimes as you mentioned, how you build wealth, and this particular person was still, kind of building his legacy for his family. Sometimes it doesn't make sense to sell. The numbers are there, but why not take advantage of taking out the profits? Maybe it's less, maybe it's half of what he was making, and having that general manager run the business for them. They have an asset that this thing is just making money hand over fist. Why sell it when there's so much potential, when you can have someone run it and you can take the profit? So sometimes, the benefit to you, obviously, with the broker, obviously they want to sell the business. With you, they can go a completely different route, pay for the service that you offered that's worth, tenfold, based off of, having them lower the expense, maybe showing them a different avenue instead of selling. So I see complete benefit. So I guess the last thing would be how and when do people get in touch with you? So if they are thinking about it, do they go to your site and are there videos, or they contact you or email you directly? Yeah.
Anyone who wants to learn more about what it's going to be like when they go to sell their business. I have a book actually, Giuseppe, that I wrote called How to Sell My Own Business. And it's on Amazon. It's on audio as well. But, if you come over to my website, davidcbarnett.com, there are videos, and I have a YouTube channel as well. There's probably close to 100 videos in the Sell a Small Business playlist. And so all that stuff is on there. It's all for free. Help yourself absorb the information. And when you're ready to, have some ink on paper and you want to really know where you stand and stuff, just reach out to me, and I'm more than happy to help you out.
Or they could just rewatch this podcast. Well, I will tell you this: you don't learn this in school. You touch on some of the topics, but I have learned more, not from my own show, from watching other people's shows, and it's truly a wealth of information, and it's free. So that's the beauty. So, well, David, I appreciate it. So, what is your website?
It's davidcbarnett.com is my blog site. It's kind of like the central place where you can find out everything that I've got going on. And you can find my contact information there too, if you want to reach out.
Awesome. Well, listen, a pleasure. As I mentioned, you're the first guest to be on twice, and learn a lot every time we speak. I appreciate your time. I know your time is valuable, and I will, we'll get this show out, and I will be using this show as my masterclass on exit strategy. So I appreciate it once again.
No problem, Giuseppe. Thank you. And we'll see you later.
Thanks again. Take care.
Thanks for tuning in. Whenever you're ready, here are 3 ways Giuseppe can help. 1. If you've ever considered owning a business of any kind, you owe it to yourself to get a copy of Giuseppe's book, Franchise Freedom. Download your free copy at ggthefranchiseguide.com/book. 2. Want to understand how successful executives make the transition from corporate to owning their own franchise? Join Giuseppe's next online presentation, Franchise Freedom: How to Escape the Corporate World and Have Financial and Time Freedom by Owning a Franchise, by going to ggthefranchiseguide.com/video. 3. Want to work with Giuseppe one-on-one to identify the right franchise opportunity for you, to navigate the process, and get plugged into experienced franchising advisors? Send him an email to gg@ggthefranchiseguide.com with one-on-one in the subject, and he'll send you all the details.